All right, guys, how you doing? This is Erik Corral again, real estate broker in the Chicagoland area.
I'm Louis with Guarantee Financial.
So for this video segment, I invited a good friend of mine, Louis here. He's one of my preferred loan officers that I work frequently with. And this video, I want to showcase the top 20 vocabulary words that every homeowner or every first-time home buyer should know.
Absolutely.
So we're gonna have a little mixture of some real estate terms, some lending terms. So we're gonna take turns, going over some of the top 20 words that I think you should know as a first-time home buyer. So let's begin. Number one, MLS. MLS is an acronym for Multiple Listing Service, which is a database that licensed real estate brokers have access to. So this is where we officially list properties for sale. And third-party websites such as Redfin, Realtor.com, Zillow, they capture our data to list a property for sale, and in return, you can see it online. So basically, it's our system that we use our searches. It's basically the system that we utilize to search for properties, and you guys can actually see them online due to the system as well. So moving on.
Yeah, the next very common term that a lot of people use is debt to income ratio, right? So a lot of people ask, how do you calculate debt to income ratio? What is a debt to income ratio? And how is that part of getting pre-approved for a mortgage? So basically, debt to income ratio is how much money is coming in as a household versus how much debt is being paid out. So, you have a car loan, credit card, student loans, miscellaneous debt reflected only on your credit. So your utility bills, your cell phone bill, your Xbox Live account doesn't count, right? So debt to income ratio, money coming in versus money coming out. So basically, we use a debt to income ratio to calculate how much disposable income you have and whether or not you can afford the mortgage.
So I got a question for you to kind of simplify things. If I have a gross monthly income of $4,000 per month,
right?
Is it pretty common to have about a 45% DTI, give or take?
Yeah, 45% DTI. It's a pretty standard conservative debt to income ratio. Depending on your credit score, that debt to income ratio could be a little bit higher, right? So the higher the credit score, slightly higher the debt to income ratio is. The lower the credit score, the more conservative banks are going to be, and the lower your debt to income ratio needs to be in order to get you qualified.
Awesome. Next word is that we see a lot in the lending side is going to be LTV, or loan to value. So again, this might be something he can answer a little bit better, but to my understanding, this is going to be the percentage of the purchase price that you're actually financing. So for example, if you're putting 5% down, that means you're financing 95%. So that's going to be the loan to value percentage.
Right. And correct? Exactly. So the loan to value is very important because essentially the more money you put down, the rate could be slightly better. Depending on your credit score, you could do a minimum loan to value of 96.5, meaning that your down payment's only going to be 3.5%. So loan to value is very important for two reasons. When you're buying a house, to determine how much money you're putting down, and for people that are refinancing, right? So when you're refinancing, your loan to value reflects how much equity your property has. So if you bought a property 5 years ago and let's say you owe $100,000, but your value is worth $200,000, you have a lot of equity in a very low loan to value. So that's going to help you get a better rate.
Just to simplify it a little bit, for your typical first-time home buyer, what is their normal loan to values?
So your most common program is FHA 3.5%. So your loan to value is 96.5. We also have conventional programs with 3% down. So your loan to value is going to be 97%.
Awesome. I'll let you take over PMI.
Yeah, PMI, something that exists that a lot of people don't like, but it's part of the mortgage world, right? So the way PMI works, many moons ago, right? The only way to buy property in this country is by putting 20% down. So if you're a family, if you're an individual that doesn't have 20% down, you were not able to buy because that was the norm a long time ago. So what happened, the government came out with programs, different banks came out with programs stating, look, you could put 3, 5, 10, 15% down. However, you have to pay a private mortgage insurance that's going to cover the remaining balance of the loan up to 20%, right? So depending on your credit score on a conventional loan, your PMI Private Mortgage Insurance is going to be fairly cheap. Whereas FHA, regardless of your credit score, the PMI is calculated the same across the board. So it's one of the benefits of putting very little down, but then over time, you want to make sure you refinance and eliminate the PMI completely.
So I think one of the things when I talk to first-time home buyers, I let them know, I mean, it's an insurance that protects the bank. It doesn't necessarily protect the buyer.
So if your house gets flooded or something happens, PMI is not going to cover that.
It's completely separate. Yeah. And then the other thing I like to kind of compare it to is similar to gap insurance for vehicles.
Right. Yeah, that's a good way of looking at it for sure.
All right. The next term that I think every homeowner should know is going to be that it's an acronym. It's a PITI payment. So it's, I guess you could say the PITI payment, but it's the PITI payment. So this is what a mortgage payment is typically, what is it called?
It's your mortgage payment comprised of everything together on a monthly basis, right?
So this covers, is going to be your principal balance, which is purchase price. It's going to include interest, which it is whatever interest rate you end up qualifying for, taxes, property taxes, and homeowners insurance. So in essence, principal, interest, taxes, insurance. So a lot of times PMI is added to this payment. So in essence, what PITI payment is basically your home mortgage payment all factored in together.
Right, exactly. So, when the client wants to know what their overall mortgage payment is, that's the PITI payment that's going to be noted on your mortgage statement every single month after your closing.
Principal balance.
Principal balance, something that we see every month when you open up your mortgage statement. Every time you make a mortgage payment, they're going to deduct the portion for taxes, the portion for insurance. They're going to take their interest payment, and then they're going to apply a certain percentage of that mortgage payment you made towards the principal. That gets added on every single month thereafter. And then on your mortgage statement, it's going to show you what your principal balance is as of your last payment. So principal balance, how much you owe.
Principal, basically what you owe.
Right.
Interest, again, this might be a term he can explain a little bit better, but interest is a percentage charge on the total amount of money you borrow. So again, just to simplify things, right now, I guess during this season, interest rates are very common to be under 3%.
Right.
Interest rates will fluctuate. For the most part, majority of first-time home buyers tend to get a locked interest rate for 30 years. So yeah, this is very common to, interest rates to range between 2.5% all the way to 3.5%.
Correct. And on that principal balance note, what your principal balance is on the mortgage statement doesn't mean that that's how much you owe to pay off the loan. It's a snapshot of when that mortgage statement was printed, right? So essentially, mortgage companies charge you interest per day. So if you get your mortgage statement on the 1st, and then you want to know what your payoff is on the 5th or on the 15th of the month, your principal balance is going to be different because of the per diem interest they charge on the loan to pay it off, essentially.
All right, property taxes. So property taxes is, I guess, in essence, the fee that the county you live in charges you for your real estate or your piece of real estate. Property taxes can come in 2 payments. Typically, they come in the spring and they come in the fall. So your property taxes are going to vary depending on the size of your home, the square footage, the amount of land, the city you're part of. So again, property taxes is important because this plays a big factor in your monthly payment, which can be the PITI payment.
Yeah, and one of the common things, especially for first-time home buyers, they focus a lot on what the property costs and don't put a lot of emphasis on what the property taxes are, right? So it's very important that you put attention to what you're going to pay for the property, but also what those property taxes are. Those property taxes, depending on what type of property you buy, where you buy, could fluctuate. If the previous owner was a senior, or we have a veteran that doesn't pay taxes. So, Eric and I, we were very careful with that. We break it down for you guys. If your taxes are going to go up in the future, we let you know as well.
Yeah, I mean, obviously, we can have a whole segment on property taxes, but just pay attention to homeowner exemptions, senior discounts, things like that, which we can cover in another segment as well. All right, so again, just to finish off the PITI payment, we're gonna go with homeowners insurance, Louis.
Yeah, so just like when you buy a car, before you drive that car off the lot, you need to have car insurance. Before the closing, we need to have homeowners insurance. Now, sometimes the homeowners insurance could either make or break whether or not you're going to get approved for a loan. So we want to make sure you shop around for good insurance with a good deductible and not a high monthly premium.
Yeah, I mean, I usually tell clients typically the best deal you can get is going to be the insurance agent that insures your vehicles. That way you could bundle your home and auto. But it's not always the case. So, definitely ask us for some to shop around for your quote. All right, to finish this segment, we're going to cover something that's really important, especially once you're pre-qualified, is going to be submitting an offer and an accepted offer. So I think there's a misconception that just because you submit an offer on a property, it does not mean you're 100% committed to the actual home. Submitting an offer just simply means that you've moved forward in signing a sales contract with price terms, closing terms. So you're actually doing the act of submitting an offer either to begin to negotiate or do a strong enough offer that can hopefully get accepted. Where the difference is an accepted offer means that it's been accepted by the second party, which in this case can be the seller, meaning they accept your terms, they accept your sale price, they accept your closing credits. So they like the terms of your offer. In a sense, essentially it gets accepted. So I like to explain that just so you know, offer being submitted as opposed to offer being accepted.
Right. And before you make an offer on a property, definitely reach out to your lender. If that lender is me, send me a text. Let me know, because one of the things that I like to do, I like to look up the actual property tax bill for the county and base your payment based on that. Sometimes the taxes noted on the listing sheet might be outdated or might have senior exemptions. So before you make an offer, make sure you know what your payment looks like. If you're comfortable with the payment, we're 100% good to go.
So again, if you're working with a seasoned realtor, for the most part, he can pre-calculate your estimated monthly payment as opposed to calling your loan officer after every single offer. But again, this is going to be the end of this segment. We will be moving forward with another 10 vocabulary words on the second segment of this video. So again, if you find this information useful, please feel free to share it to friends and family. Go ahead and subscribe to my channel, Erik Properties on YouTube. So yeah, you could keep getting more information from me and Louis.
Absolutely.